record it here. Welcome. We're going to go ahead and record this. I had a question here from one of our newer Discord members, so he wanted me to go over the positioning on the way that the open interest and hedgers or market makers, big institutions are trading now with the zero DTE and what is highly influencing the market. And so I started off by asking him if he understood what zero DTE is. If you don't know what zero DTE is, it means 0 days to expiration. So today's date is May 8th. You can see right here on the Thinkorswim, it says 0. So it's today's expiration. There's no more days till expiration on this. They're going to expire at the end of the session today. So you can see where this goes 1 DTE, tomorrow expiration, day after, et cetera, all the way down. So zero DTE started around 2 to 3 years ago. I don't remember exactly when. And ever since we had zero DTE, the rules of the game and the rules of the market actually changed a little bit, and the way that intraday trading changed a lot. And and so we have some underlying derivative positioning on here, and you could actually see what is actually influencing the market a little bit more. So if we come over, we look at the SPY for the zero DTE here today. You could, we're going to go ahead and look at the chart here first, and obviously the market is open still. So you could see where we opened up around this 515 area right here, right? Now, if we come and we look at the option chain on where we were going to open up today, this 515, and then we come and look at the call side right here, you could see that, and I'm going to use my little pen over here, there was a little bit of a gap, right? So there's a little bit of a gap right here from this 4,000 open interest here to this 15,000 open interest. So there's a gap until right here. Now the way that we're reading this right here is that this is the big open interest right here. So the reason why we're looking for the big open interest and where it starts to get thick on the call side is because for every transaction there has to be a buyer and a seller, right? Doesn't matter what you're buying or selling, Pokemon cards, you're selling anything, right? Gold, silver, whatever. For every buyer, there has to be a seller in order for there to be a transaction. So a lot of us are thinking from the way of flow trading that if someone buys a lot of calls, that it's very bullish, that it's going to go up, it's going to go to those levels or whatever, right? That's mostly correct. And so the thing is that the bigger traders, the bigger institutional market maker, hedge fund type traders started using that against us retail traders. And so the way that this works here is if we erase this, is that this area right here, this 15,000, since there was a gap right here, this is the first point that we have of resistance right here at this 518, right? And so then after this, you could see that we have a big gap of big open interest all the way up to this this 520 or so. So all of this, because of the market makers, they want the premium to expire worthless. They need the price to stay below 518, right? So underneath this 518. So this is actually downward pressure from the market makers like this. So they want all of this open interest, all of this premium to expire worthless, and so they want the price to stay below this 518. If the price gets below above here, they will start trying to push the price back down so that this will be able to expire worthless and they're able to make money on it. Now the reason that this happens is because you're able to leverage a lot more shares of underlying SPY, Qs, whatever it is. You're able to control a lot more shares with a lot less a lot less money by using the options, right? So if someone told me you could use less money to make more money, obviously you're going to take advantage of that. Now back to what we're saying here, and we're also looking on the put side. So you can see on the put side, if we open here at this towards this 515, it's within this huge gap, huge block, I should say, right, of put open interest, right? So all this high put open interest, and then you can see it drops down very significantly right here at the 518 or so, right? So all this is upward pressure. So and I know I'm drawing an arrow down, but as you can see, the strike prices move up as they move down right here. So it's a little counterintuitive. And so all of this is pressure on the price for it to get above 517. So you can see at 517, we have this 13. So the market makers want all this premium to expire worthless right here. So this is where they want the price to get above, is this 517, in order for them to satisfy and for the premium to expire worthless by the end of the day of the expiration today, right? Now, if we compare these side by side, so these people here on the put side want it to be above 517. These guys want it to be here to the 518, right? So, or they wanted to push below this 518. So then we have kind of like this Goldilocks area in between 518 and 517 here, that where the market makers are. It's creating a liquid market for the underlying derivatives in order for them to be able to exchange transactions. Sorry, there's a fly right there. Um, exchange transactions and stuff, right? And so whenever we're coming in, we're looking at our charts. So if we turn this off here real quick, we're looking at our charts, and we'll come in like towards the end, towards the beginning of the day. Oops. So come to the beginning of the day right here, before we knew that it was going to get up to five, whatever, right? So this is all the information that we had, is that we're kind of like in this area. So we know that the pressure for the market makers, they want it to be in between this 517 and this 518 in order to be able to have both the put side and the call side be Goldilocks, right? So they're making that Goldilocks connection where both sides are happy, right? So whenever you're able to put like kind of a, you're able to put kind of like um, a target, so right, so a price target on where the price and how the price is going to move for the day, if you're going to go ahead and take a trade, right? So I had said that we're going to get in between, somewhere between 517 and 518, and it's exactly where we reversed. Then I said, since this is the most liquid part, where the both satisfies the needs of the put sellers and the put call sellers as well. This is going to be where the market wants to go ahead and stay most of the day, and we'll probably chop around most of the day sideways, unless we get some type of catalyst that will break this, right? Then that's a totally different video, a totally different thing, where if we get some type of catalyst and then they have to capitulate on either side, it's totally different. And that's a different topic that we could talk to somewhere else. We're just talking on a regular market where we don't have any influence from outside catalysts or anything at all like that. And so now we pretty much fulfilled exactly like what we've seen on the option chain here this morning, where the awesome thing about this type of strategy is where we could predict where price needs to be by a certain time of day, or at the end of the day, whenever the expiration is, right? So if we come in, oh dude, I erased all this stuff, sorry. So let me see. Yeah, I erased all of it. I apologize, guys. Um, so so now we know that the price should close in between 517 and 518 by the end of the day today, right? To be able to satisfy both of those both of those criteria. So and the cool thing about this is if you come in if you come and you look at the options and the way that this is, the way that I tell my traders in my room is that we're able to make a lot more money to know where the price will not go, instead of where it should or will go, right? So if we know that, if we come and I take my little thing here, and we're at 515 when we open right here, right? So we're at 515 when we open, and we have all this open interest and everything right here. Then we're looking at that our field of play for the day is this 515, and then we come sideways, and then we're all the way to 518, right? So all the way like this, right? So this is like our football field, right? So anything in here is fair play, right? Anything in here is fair play for the market to go ahead and move. Now, it should, like I said, we should get in between here, where this is actually a touchdown and where both people are actually happy or whatever. But this leads us to not be taking any type of crazy positions way up here, anywhere at here, anywhere like here, anything like this. You're not buying really crazy outside the money type of, things or anything. You know that the price movement is going to go ahead and stay within here. So if you want to do like multi-leg type strategies within multi-leg strategies with options, such as like a condor, butterfly, etc., then you could be selling like 514 515s on the puts, and then 520s on the calls or whatever, and then you have where you will be able to make a lot of money off of the premium, because you know where the market will not move. And then when you know where the market it will not move, then you're able to better position yourself with the market makers and the big what do you call it? Bigger institution type traders, hedge funds, etc. So then you could be able to make money, and then you're not trying to trade against them. This also leads you to be a lot more patient, right? So then you're not taking trades anywhere here in the middle of this move. You're waiting for it to get up here, and you could start taking reversal or mean reversion type trades as well. So it doesn't matter what type of trader you are, mean reversion, buy the dip, trend following, breakout, or whatever. If you know where the outside limits of where the market is going to move, then you can position yourself to look for those strategies at the outer limits to be able to maximize your potential for profit. You're not just trying to scalp in the middle of the chop. So I hope that helps you and it makes a lot more sense. I may just, I don't know. This is but you can see how this works really well. I have statistics on all of this and the way that it works as well, especially when we're working with like the call wall and stuff. So the call wall is at 520. I have different statistics on how good it works as well, and it's really good. So I hope you guys enjoy. Give me some feedback in the comments. See you guys.